What if I told you there's a 400-year-old secret to investing that could completely change how you think about risk? It's a puzzle that started with the very first stock market. And the solution? Well, it took centuries to figure out, but it's one of the most powerful ideas in all of finance.
So what is this big puzzle? It really boils down to this one central mystery that, let's be honest, anyone with a retirement account has probably noticed. Over the long haul, stocks just seem to blow everything else out of the water. The real question is, why? And look, this isn't just a hunch, the data is absolutely staggering. What's so interesting here is that this is the real return, so this is after you factor in inflation. Now, a 4% gap between stocks and super safe government bonds might not sound like a huge deal, but let's put it into perspective. If you invested $100 in stocks back in 1871, by 2006 you'd have over $1.5 million. That same $100 in bonds? Just over $15,000. I mean, come on, that is a life-altering difference.
Right, so economists have a name for this. They call it the equity premium puzzle. And it really is a puzzle. Think about it. If you're at the grocery store and one checkout line is moving way faster than all the others, what happens? Everybody jumps into that line until they're all moving at about the same speed. So why hasn't that happened with stocks? To figure this out, we need to go back in time, way, way back to the very beginning of the modern stock market.
Okay, so our story kicks off in Holland, way back in 1602, with the birth of the first truly modern company. So in 1602, the Dutch East India Company, or VOC, gets started. But here's what made it so special. In that very same year, the Amsterdam Stock Exchange opened its doors, which meant people could trade shares in this company every single day. And almost right away, you get all the drama of modern markets, including a huge short-selling scandal. Short selling is just betting that a stock's price will go down. It's super risky, and in this case, it actually led to a market crash that shook this brand new system to its core. The VOC brought three ideas to the table that were absolute game changers. First, it wasn't just for one trip, it was a long-term venture, built to last forever. Second, daily trading meant you could get your money in or out pretty much whenever you wanted. And third, and this is so important, it had limited liability. The absolute most you could lose was the money you put in. These three things, a long-term company, daily trading, and limited liability, were the secret sauce that laid the foundation for, well, our entire modern financial system.
So for the next 350 years, the market was kind of like the Wild West. People gambled on stocks, sure, but there was no real theory of risk. Then, in 1952, this young grad student at the University of Chicago named Harry Markowitz has an epiphany that is going to change, well, everything.
Everybody knew the old saying, right? Don't put all your eggs in one basket. But that's all it was, just common sense, not actual science. It's kind of like making a music playlist. Instinctively, that you don't want to listen to the same song on repeat for 5 hours. You want a mix of different styles and artists. But how would you build the perfect playlist? Markowitz wanted to find the actual math behind the perfect investment portfolio.
So here's the breakthrough. Markowitz realized that the risk of an investment isn't just about how much its own price bounces around. Nope. The much, much more important thing is how its price moves in relation to all the other investments in your portfolio. Imagine you own two companies. One sells ice cream and the other sells umbrellas. When it's sunny, the ice cream company is raking it in, but the umbrella company isn't. When it's rainy, it's the total opposite. By owning both, you've actually lowered your overall risk because their successes aren't tied together. That relationship, how they move together, is called covariance.
And using this incredible insight, he created this really powerful visual tool, this curve you see here, the efficient portfolio frontier. It's basically a map of the best possible investment choices you can make. On the bottom, you've got risk. On the side, you've got return. The curve itself shows you the absolute best return you can possibly get for any given level of risk. Any portfolio that falls below this curve, it's a bad deal. You're taking on risk you're just not getting paid for. Anything on the curve is an optimal, efficient choice.
And this is where the magic of diversification really shines. Let's say you have a portfolio of stocks and bonds, and then you add a third asset, something like oil, whose price doesn't always move in the same direction. When you do that, you actually shift the entire curve up and to the left. This is the power of building that better playlist. You're not just adding a new song, you're creating a whole new superior menu of choices. We're talking higher returns for the exact same level of risk. It's amazing.
This is incredible, right? But it still leaves us with, an infinite number of optimal portfolios all along that curve.
But what if I told you there's a way to find the one single best choice for absolutely everyone? The answer is shockingly simple, and it's coming up right now.
Okay, here's how it works. First, you map out that whole frontier of all the possible risky investments. Then you add just one little point representing the risk-free rate. Think of it as a government bond. Now you draw a perfectly straight line from that risk-free point to the highest possible point on the curve it can reach. And that single point, where the line just barely kisses the curve, that's it. That is the optimal portfolio of risky assets.
And this leads to something called the mutual fund theorem. And its conclusion is, frankly, radical. It says that every single person, from a super cautious retiree to a young, aggressive investor, should hold the exact same basket of risky assets, that one tangency portfolio. I mean, just think about what that implies. It suggests that all those thousands of fancy, actively managed funds are basically pointless. In theory, all we need is one single fund that holds this one perfect portfolio for everyone.
So we found the best portfolio. But in doing all this, we've actually stumbled upon something even more profound, a completely new way of defining what risk even is.
You know, the old idea of risk was just volatility, but Markowitz showed that this kind of risk, let's call it unique risk, can be almost completely wiped out just by diversifying. For instance, a single company's factory could burn down. That's a unique risk, and you avoid it by owning lots of other companies. But what happens if the entire economy slides into a recession? That's what we call systematic risk. It affects everybody, and you can't diversify it away. And that is the only risk you actually get paid a premium for taking on.
And we have a name for that risk, beta. Beta is simply a measure of how much an asset tends to move when the whole market moves. It's measuring that non-diversifiable systematic risk. And investors use beta to build portfolios that fit their comfort level. If you're a conservative investor, you might look for stocks with a low beta. If you're feeling a little more aggressive, you might seek out high beta stocks, hoping for higher returns. And this finally solves our puzzle from the beginning. Stocks earn that extra premium because they carry this systematic risk that you just can't escape.
Which brings us to one final, really provocative thought. The math is elegant, the logic is sound. If this Nobel Prize-winning theory says there should be one single optimal portfolio for every single person, then why is the real world so messy? Why do thousands and thousands of different investment funds exist? Is it because the theory is wrong? Or is it because the financial industry has a very good reason to make things seem a whole lot more complicated than they really are? That's a question worth thinking about.